as the plot of this crisis thickens, we search to find an asset class or somewhere, a location to put our hard-earned savings. And it is becoming increasingly difficult to find such a thing. Today, we will discuss how the world bankers want an additional $100 trillion to save the economy. And this has been going on for quite some time, how additional credit, as they call it, is the only solution that they have to any of their problems. We're talking about quantitative easing. We are talking about a $100 trillion bazooka. You came here for the truth, so let me unveil that for you. Let's get into this right here of the World Economic Forum, also known as Davos, because of the location in Switzerland. It is going on right now, presently. But if we go back in the pages of history to 2011, you will see this news release over $100 trillion additional credit needed to support global growth. And this is according to all of these high-ranking officials, as they like to call themselves, the big bankers, all of these people who in fact are all part of this regime. They said credit levels will need to double over the next 10 years, growing by $100 trillion to support consensus projected economic growth. Now, this would be okay if it was a natural growth, if it was actually happening because of its own deeds. But of course, it is all being planned by the governments and by the private central banks that control them. And who do you think is at Davos suggesting these kind of things? It is those bankers, or those working for those bankers. And that's why you have them coming out and saying these kind of things. So if we go deeper into the economy, and we will talk about their policies that they have in place right now, will show you how since 2011, the World Economic Forum then, how things have gotten worse. And let's get into that right now. First, we're going to talk about Christine Lagarde. You know her from the IMF. She's the head, and she said some pretty darn words. I just do not like to read this type of thing. It really aggravates me. But let's get into it. The new networks of influence should be embraced and given space in the 21st century architecture of global governance. That right there, global governance, that means no longer does your government, it could be criminal as it is, no longer is that government going to be in charge. They go to what they like to call the international community. So let's move on here before I give my opinion. This is what I have called the new multilateralism. I believe it is the only way to address challenges in the global community faces. So essentially what she's saying with the new multilateralism is that they make their own rules, their own regulations and laws. The IMF actually has a lot of good things to say sometimes, but their solutions that they provide are absolutely terrible. And you know that specifically they are there to put a stranglehold. I've gotten into it so many times, I won't do so today. But essentially, she believes that collectively getting together and, giving up your sovereignty of your nation and allowing the global bankers to control everything, perhaps with that $100 trillion bazooka, is going to fix everything. And we know specifically that it does not. So this is a good article to see what she has to say. Some good things, then again, of course, the solutions are not good. So in my book, I talked about the result of where they have gone thus far, and this was back, I published it in January 2012. But essentially, what I wanted to show you is that with 1.5 quadrillion, that's right, I said quadrillion in derivatives that I quoted the Bank for International Settlements back from, I believe the statistic was 2011. They had that many quadrillion in derivatives, and what you're left with is what I show you here as this diagram. The diagram is essentially showing, if you can't read it, it's real assets at the bottom, that little tiny light gray triangle at the bottom, real assets, then fractional reserve banking, which is already a criminal scheme. They have their bank runs that I did in the previous video or two ago, showing you the result of a bank run. And of course, then we get into derivatives, which is approximately 25 times higher, 25 times more derivatives than there are real assets in this world. And that is not even the real assets, that is with all of their schemes like fractional reserve banking. If you include that, it is many multiples more. But even going with their GDP statistics that they show us, which are fraudulent, you're looking at 25 times more. And then they want to add on another $100 trillion. Because, of course, when you're talking about the quadrillions, $100 trillion is the only thing that's going to be able to move this in any direction. The billions of dollars are no more, never mind millions. So we're going to move on right here into China, because China is obviously the big talk of the town over the past couple decades. They've been definitely a success story, but now we have a little bit of an issue where they are trying to basically calm down the amount that their index is increasing. We saw it going up 63% in 6 months. That's the Shanghai Composite Index, and that is really, in many situations, too high. And in this case, they knew it was too high. So the regulators are trying to cool down the stock market, according to Castor Pang. He said the stock market sentiment will definitely go down, but it is for good reason, because they were allowing so much of they're gambling on margin, and that's what happens. You let it go too hot. If they don't stop it, you're going to have a crash. Well, you're going to get some sort of downfall anyway, some sort of correction, simply because people are not able to gamble as much as they used to. So let's connect that in with this right here. GDP growth, the lowest in China in 24 years. This is out of the Financial Times. China's economy grew at the slowest pace in nearly a quarter of a century last year, even as it overtook the US to become the world's largest in purchasing power terms. So we're looking at impressive statistics right here. However, you can see how things are getting bad in China. The annual expansion of 7.4% in 2014 is the slowest since 1990, when the country faced international sanctions in the wake of the 1989 Tiananmen Square massacre. So right here we have a slowdown, which, of course, they're growing at a rate that is many multiples more than other countries in Europe, for instance. But it does show you that right there regionally in China, you have a big issue. So what is the cause of this? Well, it's a global issue, as they say. Christine Lagarde wants more global governance. Well, right here we have a global problem, globalization. If the rest of the world is slowing down, China is going to slow down too. And what if you have less domestic consumption in any nation? You're going to have a slowdown as well. So we'll move on to here, just showing you China year-end, year-over-year GDP once again in a decline. You could see that since the financial crisis, it is basically moving down in a drastic line downward. They simply cannot come back up to where they were. So this also connects into another issue which I would like to discuss. and that is gold. When you're looking for an asset, where do you put your money? If you're China, if you're the US, you have accumulated a large amount of US debt. But you can see, as I showed you in previous videos, that Russia has been purchasing more gold recently, and they have been selling off of their US treasuries. China is fluctuating with theirs. They seem to buy a whole bunch at once, and then they begin to sell off, and they seem to fluctuate. But over, if you look over this recent past, you can see from their government, they are suggesting that they are going away from the US dollar. They want to allow their currency to continue to appreciate. And this brings me to my next article here, talking about Germany repatriating a lot of their gold. The German central bank, or Bundesbank, said Monday that it had stepped up the repatriation of its gold reserves from overseas storage last year. In 2014, which I did bring out this information here on the channel, 120 tons of gold were transferred to Frankfurt from storage locations abroad, 35 tons from Paris, 85 tons from New York. They want it to be located in the country that they see is the safest, and that's their own. They are no longer really trying to geographically diversify their holdings. They're bringing it back home. They're concerned about what's going to happen, and so they want that under their own wing. So one last article that does connect in with this is out of MarketWatch, talking about Marc Faber. Now, you may have different opinion on Marc Faber. However, if you've read Tomorrow's Gold by Marc Faber, you will get a very good insight as to what history shows for the future, if you understand what I'm saying there. My belief is that the big surprise this year is that investor confidence in central banks collapses. And when that happens, I can't short central banks, although I'd really like to. And the only way to short them is to go long gold, silver, and platinum, he said. That's the only way. That's something I will do. Now, people don't really understand Marc Faber's investment strategy. He has a very wide dispersion of his assets. So he owns, on average, 25% of each of the asset classes. So he's saying gold, perhaps now is a time to buy some gold. But if stocks begin to rise, or if they fall a bit, he will see that and he will buy some stocks. So it's not just buy gold, put 100% of your money in gold. He is well diversified. So that brings me to my point I have is people are consistently emailing me every single day. David, how do I protect my hard-earned savings? And yes, I do believe that precious metals are a great way to protect your savings, but you don't want to put 100% of your savings into gold, silver, platinum. You want to have all of them, of course, gold and silver definitely, but that might be just a percentage of your savings. If all you can afford is one little tiny gold coin and a few bits of what they call common or junk silver, that's great. You have your precious metals taken care of. Now, what about some storable food? What, even if you think about, buy several bags of rice, have some canned food, have things that you will consume regularly but are great for a rainy day. And if food inflation picks up, you will have these assets on hand. There are other things that you can do to protect your savings. The number one thing definitely is to pull your money out of the banking system other than what you need for, your regular daily activities. Everyone needs to buy things and they will use their bank account to do so. I understand that. But you don't want to have your savings in the bank. So that's definitely what I would recommend. This is not a video to necessarily tell you exactly what to do. However, these are just some ideas. People are always asking me, always emailing me, and that's definitely to respond to those people. Keep the emails coming in. I have several emails in my inbox right now. I'm just trying to get back to everybody. I try to email a few people per day, but it is just piling up, and it's great to hear from every single one of you. I had responded to every email in my inbox this weekend, And lo and behold, there are many, many more. I'm trying to get back to each and every one of you, and I will do so. It just takes me a bit of time, so be patient with me on there. If you found this video informative, I would really appreciate a thumbs up. I wanted to say that I wanted to thank you, each and every one of you. We are now at over 14,000 subscribers, and that is thanks to you, the subscribers here. If you are new on here, I want to say hello to each and every one of you. Thank you all for joining me on here. Stay tuned for some excellent information. If you want to reach me, the best place to do so is, well, first of all, you can email me at david@themoneygps.com, but an even better place to get me is on the insiders. I reply to each one of those people first before I move on to the other email address I just told you. And to get on there, all you have to do is go to themoneygps.com. You scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.